Tracking your investments effectively is key to growing your wealth and making smart financial decisions. Whether you're a beginner or have some experience, mastering the art of investment tracking helps you stay on top of market changes, understand your portfolio's performance, and spot opportunities before others do. In this quick guide, I'll show you simple yet powerful strategies and tools to monitor your investments like a pro, so you can take control, reduce risk, and maximize your returns with confidence. Today we will talk about how to track your investments like a pro. So before we start, make sure to hit the like button and subscribe to my channel. 1. The importance of tracking your investments. Tracking your investments is essential to maintaining control over your financial future. Many investors buy assets and then neglect to monitor their performance, which can lead to missed opportunities or unchecked risks. Tracking investments allows you to assess whether your portfolio aligns with your financial goals, risk tolerance, and time horizon. Regular monitoring helps you identify underperforming assets, rebalance your portfolio to maintain diversification, and capitalize on market trends. Without a structured approach to tracking, you may fall victim to emotional decision-making, such as panic selling or impulsive buying. Furthermore, understanding the impact of fees, taxes, and market volatility becomes easier when you keep detailed records. Ultimately, tracking investments is not just about watching numbers. It's about making informed decisions, optimizing returns, and minimizing losses in a disciplined way. By treating your portfolio like a business, you can leverage tools and strategies to act proactively, rather than reactively in the complex world of investing. 2. Setting up a system for tracking. To track investments like a pro, you need a reliable system. Start by choosing the right tools, such as spreadsheets, dedicated investment tracking apps, or portfolio management software. Spreadsheets like Microsoft Excel or Google Sheets allow for highly customizable tracking, letting you create your own formulas and dashboards. Meanwhile, apps such as Personal Capital, Mint, or Morningstar offer automatic syncing with your brokerage accounts, giving you real-time updates and consolidated views. Whichever method you choose, your system should capture essential details: the purchase date, amount invested, cost basis, current value, dividends, and fees paid. Categorizing your investments by asset class, stocks, bonds, mutual funds, ETFs, real estate, also helps in analyzing performance across sectors. Consistency is key. Update your records regularly, ideally weekly or monthly. Establishing alerts for significant price changes or dividend payouts can also be valuable. The goal is to create a single source of truth for your investments that's easy to access, interpret, and act upon, reducing the complexity of managing multiple accounts and assets. 3. Understanding key metrics. Professional investors track a variety of financial metrics to gauge the health and performance of their investments. One fundamental metric is the rate of return, which measures the percentage gain or loss on an investment over a period. Distinguish between nominal returns, raw gains, and real returns, adjusted for inflation. Another key metric is the dividend yield, important for income-focused investors, reflecting how much income an investment generates relative to its price. For risk assessment, consider volatility, often measured by standard deviation, showing how much an asset's price fluctuates. Bid indicates how an asset moves relative to the overall market, helping assess market-related risk. Tracking the price-to-earnings (P/E) ratio and other valuation metrics can inform whether a stock is undervalued or overvalued. Understanding these metrics helps you compare investments objectively, rather than relying solely on price movements. Additionally, tracking your portfolio's overall diversification through correlation metrics can reduce risk and improve stability. Armed with these insights, you can make more calculated decisions to enhance portfolio performance. 4. Using technology to automate tracking. In today's digital age, leveraging technology is vital for efficient investment tracking. Many modern portfolio trackers sync directly with your brokerage and bank accounts, automatically importing transactions and current valuations. This automation saves time, reduces human error, and provides instant access to real-time data. Advanced platforms even offer features like tax loss harvesting alerts, performance benchmarking against market indices, and scenario analysis to forecast potential outcomes. For investors with diverse portfolios, tools that provide asset allocation breakdowns and diversification scores are invaluable. Additionally, many apps allow you to set custom notifications for price changes, dividend payments, or news alerts related to your holdings. Some platforms also offer mobile apps, enabling you to monitor your investments on the go. However, while automation streamlines tracking, it's important to periodically review data for accuracy and maintain a personal understanding of your investments. 5. Keeping track of fees and taxes. A critical, often overlooked aspect of investment tracking is monitoring fees and taxes, which can significantly erode returns over time. Brokerage fees, fund expense ratios, and advisory fees should be recorded and reviewed regularly. Understanding how much you're paying allows you to seek lower-cost alternatives if necessary. Taxes also play a pivotal role. Tracking realized capital gains and losses is crucial for tax planning. Long-term capital gains are usually taxed at a lower rate than short-term gains, so knowing your holding periods can impact when you decide to sell. Dividend taxes vary based on the type of dividend and your tax bracket, and interest income from bonds may be taxed differently. Keeping detailed records simplifies filing taxes and helps you identify tax loss harvesting opportunities, where you sell losing investments to offset gains. 6. Rebalancing and adjusting your portfolio. Tracking investments is not just about monitoring but also about making strategic adjustments. Over time, some assets may outperform others, causing your portfolio's asset allocation to drift from your target. Rebalancing, selling some assets and buying others to restore your original allocation, is essential to managing risk and maintaining your investment strategy. For example, if stocks have grown to constitute a larger portion of your portfolio than intended, you might sell some stocks and buy bonds or cash equivalents. Regular rebalancing helps avoid overexposure to any single asset class or sector, reducing vulnerability to market downturns. The frequency of rebalancing depends on your strategy and tolerance for transaction costs. Some investors rebalance quarterly, others annually. Tracking your portfolio's current allocation and comparing it to your target allocation allows you to make informed decisions about rebalancing. 7. Interpreting market news and trends. Successful investment tracking involves staying informed about market conditions, economic indicators, and geopolitical events that influence asset prices. Monitoring relevant news helps you understand why certain investments are moving and how global trends might impact your portfolio. For instance, interest rate changes by central banks can affect bond prices and stock valuations. Economic data such as employment reports, inflation figures, and GDP growth can signal shifts in market momentum. Sector-specific news, such as technological breakthroughs or regulatory changes, can influence individual stocks or industries. Following trusted financial news sources and subscribing to market analysis newsletters can provide timely insights. Incorporating news analysis into your tracking system helps you anticipate risks and opportunities, enabling proactive portfolio adjustments. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.